Hello and welcome to today's Premium Account Market Update for ASX Top 50 Stocks July 2019. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, Managing Director of Investor Signals, have 24 years of experience in the financial services industry as a licensed securities and derivatives advisor. The topics for today, we look at the macro update driving equities. We roll through the ASX Top 50 shares with a focus on FY19 and FY20 earnings. We look at the technical trends, our portfolio allocations, and conclude with a short-term market outlook. Our premium account service is a model portfolio of ASX 50 stocks. We utilise call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates, generating above average cash flow whilst looking for capital growth, all in a strict investment mandate. Therefore, it's suitable for self-managed super funds and the assets remain in your name. If you'd like to know more about the Investor Signals premium account brokerage service, please contact me on 1300 614 002. We also now have an unit trust where you can get exposure to our algorithm strategy, which is relatively, whilst the technology and concept has been in development for really over 20 years, the actual launch of the Investor Signals Unit Trust has only occurred in the last 2 or 3 weeks. But the chart up on screen there shows you the 5-year historical performance of the algorithm model versus the XJO. So we're quite excited about the opportunities that the algorithm model presents, and you can see there the strength in the rebound of the algorithm model versus the index following the heavy sell-off during December quarter has led to extremely good returns year to date. So if you'd like to know more about the unit trust, please give me a call, 1300 614 002, or email me, leon@investorsignals.com. Okay, moving straight into the top 50 stocks, and I'll start by having a look at the XJO and just chat about the macro picture, in particular in the US. So we've got S&P 500 companies ready to begin their June quarter earnings next week. So we have the large banks, Wells Fargo, JP Morgan, lead next week, and that'll give us, I think the US banking shares will actually be reasonably well. I think where the risk obviously lies is industrial companies converting international earnings back to US dollars, which has obviously the US dollars remained high, which will hurt at the margin. We've seen slower economic growth in Europe and for most parts of Asia, and consensus for the S&P 500 earnings is for really no growth. So we've seen no growth from the December quarter, so March and now June. That's priced into the market. So again, there's no lofty expectations that earnings are going to be terrific as the results start to come through over the next few weeks. What's driven equities higher is obviously interest rates have gone lower globally, and the search for yield or the search for income has pushed money into equity markets. So it's a really important distinction for investors to understand that the rally is not being driven by increasing earnings, it's being driven simply by interest rates going lower. And you would have to say that is now reflected in share prices. So what the market consensus picture is telling us is the market's comfortable with flat earnings through till September, but by the December quarter the market's expecting S&P 500 earnings to re-accelerate up to 8 to 10% earnings growth by the end of this year. So if that doesn't happen, then that's where the disappointment gets set up for the market. We think in the short term the market can probably mostly bump along sideways in an environment with low earnings growth, knowing that the central banks are there as a backstop and interest rates are probably easing back as required. So with that in mind, let's go into the top 50 stocks and we'll toggle through these and have a look at the closer sort of view around these stocks. So AGL's been added into the model portfolio. We're looking for maybe sort of flat earnings picture in AGL, but it's got a reasonably solid dividend yield at about 5.5% yield, so it should be well supported here. So this is an example where we're happy to own the stock and we're selling European covered calls to capture the upcoming dividend and strip out a bit of extra income through the option premium as well there. Now, Aristocrat Leisure, this remains under sell conditions, so we're mostly not holding this in portfolios, but happy to have a look at it in the back half of this year on the next higher low or the next algorithm buy signal, but not doing too much there. It's come back to a reasonable PE, about 19 times earnings. But it's one of those companies that I think, as the earnings results for the Australian companies come through in late July, August, I'll analyse Aristocrat's earnings and update it via the blog. Amcor's completed the merger with Bemis Group in the US. I've been chatting about, or speaking to the cost savings that are likely to come through. I think the number's about $160, $180 million off the back of that merger. The concern here with Amcor's been slower global growth doesn't create a backdrop that sort of lends itself to requiring more packaging. At about 4% yield, Amcor's fair value, as this sell-off plays out at around $15.50, I think it starts to reflect good value again. Now, in saying that, I think it moves sideways, so it's buying it on this sell-off, but back up above $16, I think you should sell covered call options and boost that dividend yield from sort of 4% up to 10% from the dividend and the call option premium. AMP, it's very tempting to make a call that now's the time to buy AMP. The concern is really just what the ultimate liabilities end up being that the company faces. My thinking around this has been that probably in the back half of this year, AMP makes some announcement about restructuring the business, which will really unlock value for shareholders. So whilst it's a gamble at the moment, because there's a bit of a vacuum of news around what these liabilities look like from settlements, I think it's just from a pure timing standpoint. I think the board's had enough time to, I think, sort of quantify what the wash up of the Royal Commission and the liabilities are, and to begin strategizing around what the future of AMP looks like. And I suspect it's not as a as a conglomerate, if you like, as it stands at the moment. I suspect they end up splitting the funds management business away from the advisory side of the business. So one just to have a think about, but it's certainly not under buy conditions at the moment. ANZ, so the Australian banks, ANZ's in the model, as is NAB. In the case of ANZ, we see a higher high there at around $29, higher low at around 27. I think we're getting down to a level where you can think about buying ANZ if you don't already own it at or near that $27 level. APA Group, not doing there at present, but that was a beneficiary of lower interest rates. So APA Group's the gas pipeline business. You may remember some months back, Hong Kong Group made a takeover offer and was blocked from proceeding, but as interest rates went down, we saw APA Group rally. Now, ASX has been a favourite of the market, and I think it's always interesting just to look from a valuation standpoint where we're at. ASX is now pushing well over 30 times earnings, and it's dropped below a 3% dividend yield. If you go back 5 years ago, this business traded on 16 times earnings and a 5.5% yield. It's under algorithm buy conditions. If we look at the history, it switched from sell conditions into buy conditions, and we had recent signals on this low down here at around 57, and it's pushing much higher. It's been one of the better performing stocks within the algorithm model portfolio. AZJ, this is one that earlier this year I'd made reference to that the stock was likely to start to recover in 2019, and we've seen that. I think that's now played out. I don't see too much more upside for AZJ. The attraction here is that even if the company grows earnings in low to mid single digits, the stock's still on an attractive, roughly sort of 4.5-5% yield. So money, is moving into pockets of the market that are still trading up around that 4-5% yield, because clearly it's attractive versus bank interest. For us, we'll take a look at AZJ again in towards the maybe the back half of this year, early next year. We'll wait for the sell-off and a higher low formation before really aggressively setting up for a longer term trend in AZJ. BHP continue to like this. It's switched from sell conditions to buy conditions. Iron ore prices have really rallied well above where, say, consensus estimates. If you go back a year ago, most analysts had spot prices at about $65 to $80 a tonne when forming a valuation on BHP, Rio, Fortescue. Iron ore's rallied up to $115 a tonne. If you put in spot prices into the valuation models, BHP and Rio would be still at least 20 to 30% undervalued if iron ore stayed up at these elevated levels. But most analysts see iron ore pulling back to around that $80 a tonne level and then eventually back to 65. The conclusion on this is that I think you have to have a view that I think BHP is the better choice over Rio. Oil prices are likely to stay reasonably well supported. But we're happy owning BHP but selling covered calls over it and generating some extra income, or simply trading it. This feeds into my view that a good outcome for the market is that if we move sideways. Brambles, it's been a while since we've seen a sell-off here, so this is an example of where stocks just got too expensive. Brambles was trading almost 24 times earnings on a 2.5% dividend yield, a little like Amcor. This weak backdrop of global demand makes it hard to justify Brambles trading at a premium. So I think you're seeing Brambles pull back. Get ready for an algorithm buy signal on it. I'm not sure whether the number is $11.50 or $12, but over the next few weeks we're certainly getting into a level where we expect to see a buy signal on Brambles, and I'm happy to take action on it. So I think at a 3% dividend yield, Brambles is pretty safe buying, and small rally and then look to sell covered calls over it. CBA, view is that it's up against resistance here. I think it struggles to go too much higher at the moment. Obviously the banks not only have the settlements that pay payouts, but they've spun off a number of wealth management, insurance businesses, and so on. So it leaves a bit of a hole in the revenue for the business, and costs are certainly not going down for the moment in the bank. So because the economic environment has the worst case scenario has not played out. The banks are still attractive from a yield standpoint, but they are looking expensive, especially in CBA case. If we're looking at the banks, we like ANZ and NAB as our preferred exposures, and to a lesser extent Suncorp. Cochlear, I think this is expensive up here, and you want to watch these short-term indicators. I think we're getting pretty close to a level where it rolls over. Maybe we get a pullback back down to 175, 180 later in the year. That'll switch it into buy conditions, and we'll have a look at it. But that's more of sort of a picture for the next 6 months. Coles Group, I think this is expensive. The rally is driven by the large cost-cutting announcement the company made. Again, later this year, we'll see a pullback in the price, maybe back at around $12.50. We're a buyer of Coles. Computershare, this is one I've been warning about on the blog. There's structural headwinds here that Computershare faces. Ultimately, it probably trades back down to around $15 before finding support. So we're not doing anything there at the moment. CSLs are holding in the model. It switched from sell conditions back in 2014 into buy conditions in 2015. We had the most recent buy signals around this 180 level, pushing now 220. And the long-term story for CSL remains attractive, albeit the stock is expensive. But with fairly certain double-digit earnings growth, 10 to 15% earnings growth, I'd expect CSL just to gradually move higher. Caltex disappointed the market with a earnings announcement that came in well below expectation. We saw the stock price fall from 26 down to $21. It's rallied back to what I would consider fair value at around 26. Time to sell covered calls over. The stock trades on about a 3% dividend yield. I think for the moment it moves sideways, but it's not a holding that's in the model portfolio. Dexus, these property trusts have all performed extremely well. It's one of the reasons that the algorithm model portfolio has done so well. It was overweight Goodman Group, Dexus, Centre Group, GPT. And if we look at the technical signal, switch from sell conditions into buy conditions, they're at around $10 and continues to move higher. Fortescue's not in the model at the moment. Out of Fortescue, Rio and BHP, BHP's the one that is. So we focus our effort there. In the case of Fortescue, we look for a pullback over the second half of this year, and we may take another look at it on an algo buy signal back between $6 to $7. Goodman Group switched from sell conditions into buy conditions here at $10. The stock's up by almost 60% in the model portfolio. We had another signal here at around $12.70. Stock now pushing $15.75. Does look expensive, but it has for a long time. Goodman Group's now trading on less than a 3% dividend yield and delivering about 8% earnings growth. But I've explained in the past, the market's excited about its exposure to these online fulfillment centres, the big logistics centres that Goodman Group's building globally, and you're now starting to see GPT jump on that train as well, which should be good for GPT's share price over the next sort of 1 to 5 years, providing interest rates stay relatively low. And with that, we're looking at GPT, so it switched from sell conditions into buy here at around $5. It's since made its way up to $6.25. They just did a capital raising and provided a discounted rights issue to shareholders. That, I think, helps explain people have been selling the shares and replacing it with the ones they're picking up at the discounted price. It finds support here, and GPT's a buy, and I suggest it's one that you take a close look at on this sell-off. So somewhere between sort of really say 610 and 620, we're now into the buy zone. I don't think it stays down at those levels for long. Insurance Australia Group looking a little bit expensive. It is in the model. It's switched from sell conditions to buy conditions here at around $7.50 now, pushing $8.55. We'll have a look at this one with the upcoming earnings results. The market's looking for about 5% EPS growth. The stock trades on about a 4.5% dividend yield. So at the moment, we own it at lower levels, and for the most part, we've sold covered calls over Insurance Australia. James Hardie, not doing anything there at the moment, just highlighting that it's under sell conditions, so we've got resistance at around $19. Lendlease. Now, there's not many stocks that are under sell conditions that are highlighted as buys. History tells us that following the algorithm model leads to a good sort of structural trends within stocks for the most part. But occasionally, from a fundamental point of view, it's worth just highlighting. Now, Lendlease, I think it's undervalued. I've been promoting that for a while. It's pushing its way back up from sort of $11 up to $14.40. The price gap technically is back up to about $17. I'd like to see the stock trade above 15 and consolidate somewhere around that $16 mark. And the catalyst may be the upcoming earnings in August. And I've explained previously about them looking to sell off that engineering division that's created the liability that caused the large sell-off in the share price. So if we see any confirmation that they've found a buyer for that engineering division, it'll help unlock value for Lendlease. Mirvac, not doing it there at the moment. It is under sell conditions. It's broken out into a higher high. We'll take a look at this later in the year on the next major pullback. Medibank, this looks expensive up here, and I wouldn't be getting too aggressive on the long side of Medibank unless we saw a pullback back down to around $3. Macquarie, Delivering double-digit earnings growth, the stock softened a little because of a fairly weak outlook for 2020, where Macquarie indicated that they were thinking that earnings would be relatively flat. It's not unusual for Macquarie to sort of provide under promise and over deliver. The backdrop for equity markets is that a good outcome is we bump along sideways for a while because of the low earnings growth picture in the US. Um, Probably not an environment that Macquarie rallies in the short term, but I suspect that it consolidates, moves sideways, and then later we see Macquarie move a little bit higher. It is on attractive dividend yield, about 4.5%. National Bank, so this along with ANZ is in the model portfolio. National Bank's exposure to sort of more of the business customer, I think it is helping for it to be sort of a favoured bank rather than sort of say Westpac, which obviously has a higher exposure to residential mortgages. So we had the buy condition in NAB on the pullback back to around $24, now pushing 27. Maybe there's sort of 5% upside in the bank short term, but not too much more than that. Newcrest looking expensive, and in the back half of this year, if we see a more significant retracement, we'll take another look at Newcrest. Origin Energy, so this is a little like Lendlease. I actually like the story of Origin, although it's under sell conditions. This earnings season, Origin will update shareholders on reinstating their dividend, and based on sort of the fact the company's paid down its debt, oil prices and natural gas prices have remained reasonably robust. Origin's exposure to the LNG or the dividends coming through from their project at Curtis Island, I would expect to see this stock pretty quickly move back up to around a 4.5-5% yield, and based on that, the stock price should re-rate back up towards around $8.50 as fair valuation. Orica not doing it there at the moment. Oil Search under sell conditions, but looking a little oversold here at $7. Qantas not doing it there, still a bit cautious on Qantas, and I think maybe the trend's more to the downside than the upside. QBE. 4.5% dividend yield for QBE. Generally, you'd like to see interest rates moving higher to provide better returns for QBE, but a lot of their asset portfolio should be at the margin a beneficiary of higher equity prices. So I think it could surprise a little bit on the upside upcoming earnings result for QBE. Ramsay getting a little expensive. We'll look at that on the next sell-off. Again, BHP's our preference over Rio. South 32, little oversold here, but base metal prices have been fairly weak. So, which is in contrast to iron ore, which has been strong, but the base metals have been weak. But we've seen South 32 correct from $4 down to $3, and it should get a little bit of short-term buying support there. Scentre Group, from a yield standpoint, stock's paying almost a little over 5% dividend yield. The company's buying back their shares, owning it here and selling covered calls generates 10% cash flow. It's one that we're comfortable owning. Stockland's getting close to full value, running into resistance. Sonic looking a little expensive, sort of 22 times earnings on just over a 3% yield. We need to have a look at the upcoming earnings result and analyse that a bit closer. Santos, now Woodside, out of the three energy names, but the Santos, Oil Search and Woodside's the only one that's in the model at the moment. Santos probably consolidating, but should break out to the upside. Oil Search a little oversold at $7, but again Woodside is probably the pick of the three, but running a covered call to boost the returns. Suncorp, so this is under buy condition. So if we think about it, you've got ANZ, you've got NAB, you've now got Suncorp, you've got Insurance Australia Group as your core financial plays. The ASX is in there as well, but at a fairly expensive PE ratio based on historical standards. Owning Suncorp here and selling a slightly out of the money call and turning it into 10% income is our preferred strategy. Sydney Airports, So this has broken out from the downtrend. We had the algo buy signal at around 740. It's probably trades sideways more than anything else at the moment. The lower bond yields are priced in. There's not that much earnings growth, maybe 5%. So I think it moves sideways. Seller covered call over it, and you're waiting until now December to get another dividend out of Sydney Airports. Transurban, again, as interest rates have gone lower, money's poured into this. To me, it looks expensive. Telstra getting up against resistance. You really need to see more proof of earnings growth coming through in the August results. Again, inexpensive where it is at the moment. Treasury Wines runs into resistance at around $17. It's a name again that I'd like to see more evidence of ongoing earnings growth. You may recall the company was growing earnings at around 20%. I think that's fallen back to maybe 10%, so we'll take a closer look at the upcoming earnings result. But for the time being, Treasury's under sell conditions. Vicinity is under buy, but it's probably my least preferred property trust, so we don't get not doing too much there. Westpac again, preference ANZ and NAB out of the banking stocks. Wesfarmers, we've seen a slowdown in the department store sales for Wesfarmers. Bunnings probably continues to deliver 8 to 10% growth, puts Wesfarmers on 4.8% yield. We're starting to get back up to resistance at around $38. Longer term, the company's strategy around rare earths looks like it should add value to the business, and for that reason, later this year, if we see a correction and a more substantial algorithm buy signal, we're happy to add Wesfarmers back into portfolios. Woolworths, expensive from a historical standpoint, now pushing up to about 24 times earnings on just above a 3% dividend yield. A little like ASX, if we go back 5 years, think about what Woolworths traded at. It was about 14-15 times earnings and about a 5.5% yield. So now you're paying 24 times earnings. So it's just a function of lower interest rates. So as long as rates stay low, Woolworths can bump along sideways, own it, sell covered calls, generate 10% cash flow from the dividend and the call option. Woodside, so we like this. The bullish structure here at around sort of $30 support, and then further higher support around $34.35. Stock moves sideways, sell covered calls on the other side of the upcoming dividend, and there we are back to the index. Now, the test for the market's going to be the upcoming US earnings. That starts next week. If we see earnings do worse than the flat picture that the market's anticipating, so as the earnings start to come through, if we start to see something that reflects sort of 5-8% fall in earnings, even the lower interest rates are not going to save the market. So they're from having some sort of correction. Not on the verge of a meltdown. But we just need to be a little bit cautious that we're not seeing earnings accelerate at the moment, and the driver of the market is expectations that synchronized global growth occurs and earnings pick up in the back half of the year. My way of approaching this is I think you're better off forming a view that until earnings pick up, you're better off positioning portfolios around the basis that the market moves sideways and just trying to keep a little bit of protection in place in portfolios. So one way of doing that is just to keep an eye on this index. This is our market, if you start to see the index roll over, maybe the shorter term average come down below the longer term average, and I'll update you on the blog as to my view around this, then you just need to start to build a bit more protection into portfolios. But for the moment, there's some good quality names there paying good dividends, and buying them on the dip is continuing to lead to good returns. Thank you for listening in, and if you'd like to discuss any details around the market or the strategy, please give me a call on the office number. Thank you for listening.